Well, one of the stock stories we've been tracking this morning is Netflix, the streaming giant coming out with its quarterly results. Very strong numbers compared to what Wall Street was looking for, and the shares continuing to climb today. Interesting that since the lows from 2022, this stock has now rallied between 400% and 500%. Now, given that rally, our next guest stands out amongst the analysts as one of the more cautious researchers on Wall Street. Joining us now is Matthew Dolgin. He's a senior equity analyst at Morningstar Research, and it's great to have you with us this morning, Matthew. Thanks for your time.
Hi, John. Thanks for having me.
It's good to have a conversation with bullish and bearish themes because that's what makes a market. But it did seem like Netflix had a lot to be pleased about in the most recent quarter. When you look at the company right now and the stock, what do you see?
Well, when we look at the company, we think things couldn't be going much better. This past quarter, the subscriber additions were really phenomenal. I mean, it was a record quarter for the quarter. The year was a record. Our concern is that things can't get much better. Now, we have underestimated how long this would persist. But when you look at the penetration in the U.S., which is the highest priced market, which is where the company gets most of its revenue, as well as the valuation and the fact that we think things need to decelerate from here, we just can't get our hands around valuation. So again, from the business's operations point of view and it being leaps and bounds ahead of competitors, there's nothing not to like. But as far as the price you're paying on the stock, it gives us concern.
Okay, let's go a little deeper into the weeds here on how you value a company and what's making it trickier for you to feel bullish about a stock like this after the run-up. How do you measure the company based on the valuation today?
Well, at Morningstar, we use a discounted cash flow model. So we are projecting well into the future. And that's, I guess, one of the places where we have a disconnect maybe from where the market is right now. Our fair value estimate implies 30 times 2025 earnings. The stock's trading more like 40 times right now. But again, our biggest concern is that we think things have to decelerate. Again, we expected that to be more pronounced in 2025 than it looks like it will be, because with those subscriber additions, they should have a nice runway to really getting into low teens growth again on the top line, and margins continue to expand. But when you look beyond that, again, with the penetration in the US and the phenomenal subscriber additions they've had over the last year or two, it's going to be tough to replicate. And when you see growth coming down and when you start having fewer areas where you can get higher margins, this is a company that needs to continue investing in content every year. So there is some limit to how much is going to drop to that bottom line in the free cash flow. And when we look at all of that over the course of the next few years, rather than just 2025, that's where we have a tough time seeing this as $1,000 stock.
Okay, and I want to stay in the nitty-gritty of stock analysis for just a second, because I think some people have highlighted that Netflix is no longer going to be sharing their subscriber numbers each quarter the way they did today. And I've been covering this company for many years, and for the bulk of those years, people would immediately look to the subscriber number every quarter to determine how the business is doing. Obviously, they've added more elements, and they've got the advertising business. But, look, Meta went through a similar chapter where they didn't want the focus to be on total users growth in any one quarter. It was really more about how the platform overall is performing, et cetera, et cetera. How does your ability to analyze the company change if they're being a little bit more quiet about the actual subscriber numbers?
Well, it does get tougher, and that's assuming it doesn't start giving us other metrics to go on, because as of right now, with the company no longer disclosing subscribers starting with the next quarter's earnings release, we're just going to have the top line, the high level revenue in each of the 4 regions that it discloses. if at some point advertising revenue becomes a bigger piece and they start giving us more metrics related to that, even if it's just what advertising revenue is, even more beneficial would be if we saw how many advertising supported subscribers they have and the breakdown between that and their ad-free subscribers. Those would alleviate some of the difficulty in not having the overall member number. There's reason why the company why it's doing this makes sense, which is because, like we said, we think member additions, you're kind of getting to the end of where that's going to be a huge driver of the growth, and the ability to monetize more with advertising, with some of the price increases, is going to be more central. And as far as where the growth is coming from, when some of it comes from regions outside the U.S., which I mentioned was the highest priced and therefore highest revenue market, it makes sense that you want to take the focus off of that. But again, to your question, it will make it more difficult without some further disclosures than what they've given so far beyond member numbers.
Okay, just a final question for you, because you keep tabs on a range of companies, including other players in media. If all roads have led you to feel cautious about investing in Netflix, and people are listening to what you're saying right now, you know, traditional media giants have struggled to capture the attention of investors the way that a Netflix has. Does that leave those valuations looking more reasonable? I mean, do you see more opportunity in some of the other media stocks compared to Netflix? How are you thinking about that?
We do see more value elsewhere, but at least for example, Paramount and Warner Bros. Discovery, it's the exact opposite of Netflix because their businesses have struggled. And so we see value there. We think there are value in their assets. We think that their streaming services are going to improve further and take more of the focus away from the declining traditional legacy television business. But at this point, there's not reason to see the stock moving. We kind of think Disney is straddling that happy medium where we think the valuation is very reasonable and we see upside. It does have the declining legacy television business, but that's not as big a piece because of its parks. And it's also further along than the other competitors I mentioned in terms of its streaming services. And of course, it's making a big stride in 2025 with the rollout of the ESPN streaming app, as well as some of what it's doing with its stake in Fubo, should that go through. So Disney is the one that probably marries the valuation and the near-term fundamentals looking decent the best.
Okay.